Okay, let's unpack this. We're deep diving into Benjamin Graham's The Intelligent Investor.
A book Warren Buffett famously called the best on investing ever written.
It really is the foundational playbook. So our mission today is pretty simple. We want to extract the core philosophy and the 5 most powerful lessons from Graham.
And what's so fascinating is that the book is absolutely not a guide to getting rich quick. Not at all.
No.
Graham, who we call the father of value investing, he made it clear. Success in investing has less to do with being smart and, way more to do with discipline.
Because the markets change, but people don't.
Exactly. Fear and greed, they are constants.
So the big idea here is that the greatest threat isn't a market crash, it's you. It's your own emotions. You're either investing, which is based on analysis and safety, or you're just speculating.
Which Graham defined as guesswork, hope, excitement. And that internal battle brings us right to his first huge idea, the emotional challenge he called Mr. Market.
Mr. Market. I love this concept. It shows you aren't competing with Wall Street. You're competing with your own gut reactions.
That's it.
The classic mistake is buying high when you feel greedy and then panic selling low when you're terrified.
Right. And Graham gives you this image. Imagine Mr. Market is your business partner, and every day he shows up at your door. Some days he's euphoric, totally manic, and offers to buy your shares for way too much money. Other days he's terrified and offers to sell you his for pennies on the dollar.
So the intelligent investor uses his mood.
You use it. You don't follow it. You only transact when his emotional state gives you a clear advantage. If you buy when he's optimistic, you're just a speculator.
Okay, so if controlling your emotions is defense number 1, what's the financial backstop? The tangible rule.
Well, that takes us right to what Graham called the 3 most important words in investing.
The margin of safety.
The margin of safety. It's the cornerstone of his entire philosophy.
And it's basically just buying something for a lot less than it's actually worth.
Simple as that. If you've analyzed a business and you think it's worth $1 a share, you don't buy it for 95 cents. You wait until you can buy it for, say, 60 cents.
That 40-cent gap is your buffer.
It's your protection. It's your safety net against bad luck, errors in your own analysis, or just, the world being unpredictable. Patience is protection.
And this idea of patience, it links directly into the 3rd principle, doesn't it? Treating investing as a business.
It does, because you're not gambling on a stock ticker. You're buying a piece of an actual operating business.
With real assets, real customers.
You have to think like an owner. Would an owner sell their entire business because of a scary headline? No. They focus on long-term stability. All that frequent trading just racks up costs and leads to worse results.
So Graham recognized that not everyone has the temperament for that deep analysis, which led to his 4th idea, the 2 different paths.
Right. The defensive versus the enterprising investor.
2 distinct strategies.
The defensive investor is, for most people, really, it's about simplicity, safety, maybe buying some low-cost index funds. The enterprising investor, on the other hand, is actively hunting for those deeply undervalued companies.
Which takes a lot of work and discipline.
A ton of it. And the lesson here is you have to be honest with yourself. Which one are you? Your strategy has to match your personality and your lifestyle, or you just won't stick with it.
That discipline. That brings us to the 5th and final principle. And it's a big one. Discipline always trumps prediction.
Graham was so skeptical of market forecasters, he thought it was a fool's errand.
Trying to guess what the market will do next year, next month, next week.
It's a distraction. Because if you can't predict, you have to rely on consistency. Time is your greatest weapon. You build wealth slowly, quietly, by just staying invested. Consistency will beat guesswork every single time.
So when you put it all together, control emotions, demand safety, think like an owner, pick the right strategy for you, and be disciplined. It's really a framework for managing yourself, not the market.
Precisely. The book doesn't promise excitement. It promises clarity and, I think, resilience. It reshapes how you think about money so you can build wealth with confidence no matter what the market does.
So we want to leave you with this final thought to mull over. If successful investing is calm and, boring, what costly mistake might you be making right now because you're looking for excitement in your portfolio?
Yeah.